If you are holding a rental property and you're not following CRA income tax folio S3, F6, C1, you're actually losing hundreds of thousands of dollars over the lifetime of your mortgage. At that point, your rental is not an investment anymore, it's a liability. In the next few minutes, I'm going to show you exactly why two identical landlords with exactly same income, same property, end up with $320,000 difference in their net worth. And it all comes down to one restructuring decision that been sitting inside the Canadian tax code. So let's talk about two different standards. Before I explain what separates them, ask yourself this. If there were a legal CRA approved way to turn a break-even rental into a structure that actually works for you instead of against you, wouldn't you want to understand it? Let's go into the details. Both landlords have a $500,000 mortgage on their primary residency. A rental property that barely cash flows, neutral at the best, maybe slightly negative. That's the reality for most rental incomes right now in Canada. Landlord A, let's call him Dave, does what most people do. Rental income goes into the account, expenses come out of that same exact account, employment income pays down the personal mortgage, no structure, no coordination, just hoping appreciation eventually will make sense and will make it worth it. Okay, on the other side, we have a landlord B. Let's call her Sarah. Sarah does three things differently. What Sarah does is not new. It's not aggressive and it's not a loop. It's clearly outlined in a CRA income tax folio, like I mentioned before, in S3 F6C1, the CRA has literally published guidance explaining when interest is deductible and when it's not. Now, let's look at Dave's mistakes. Every dollar Dave uses from his employment income to pay down his personal mortgage is gone for that debt is not tax deductible. At the same time, the tax code allows interest deductibility when borrowed money is used for the purposes of earning income. Sarah flips that structure. She uses a rental income about, let's say, $26.30 per month to aggressively pay down her personal mortgage and including prepayments. To cover rental expenses, she borrows from equity line of credit that tied to her home. Borrowing to pay expenses sounds wrong at first, but the purpose of the borrowing is what changes absolutely everything. So when the money is borrowed specifically to pay income producing expenses, the interest becomes tax deductible. Every dollar of interest Sarah pays on that borrowed amount is now deductible, exactly as described in the series. Here is what happens next. Sarah pays off her entire $500,000 personal mortgage in just over years. At that point, she has about $342,000 outstanding on her line of credit. Dave, meanwhile, still owes roughly $370,000 on his mortgage. None of it is tax deductible. So ask yourself honestly, which position would you rather be in? Over time, Sarah generates approximately $69,000 in tax refund. When those refunds are applied to the balance, the entire structure paid off in about 19 years instead of 25. The difference between Sarah and Dave over the life of the mortgage is $320,000. Dave gave up roughly $16,000 every single year by not structuring this property. That is about $1,400 per month, but because no one ever explained to him how the system actually works. That money could go for groceries, car payment, education savings, and it's just gone. If you are operating like Dave, why are you holding that rental at all? You're paying extra tax to own an asset that does not cash flow and doesn't help you to build the flexibility. Most people have accountants, many have financial advisors. So why hasn't anyone told them about this specific strategy? Because most professionals are focused on filing your taxes and not structuring it. They look backwards, they basically complete forms for you. They don't redesign how that works inside your life. Now, before you assume this works for absolutely everyone, there are three critical rules you need to understand. First, purpose. So first, matters more than account. CRA does not care which account the money flows through. They care why the money was borrowed. Every dollar pulled from line of credit must be traceable to an income producing expense. Repairs, maintenance, insurance, property taxes, professional fees, mixed personal spending in that account in you contaminated the deductibility. Clean separation and documentations are not optional in this scenario. Second, this is not about increasing your debt. It's about changing the type of debt you already have. Dave still has debt. It just works against him. Sarah also has debt, but hers produces tax returns. The tax system rewards income producing debt. It penalizes personal debt. You are not bending the rules, you're just aligning with the system. And third, this strategy is not for everyone, like I mentioned before. If you don't have a stable income, if you don't have spending discipline, or you don't have sufficient equity, forcing this can backfire. This only works when the rental is a long-term, cash flow is predictable, and the structure is reviewed and monitored constantly. This is not just set and forget off strategy.